The US economy is facing two serious challenges. The first is the ever-increasing national debt. Just 7 years ago, back in 2017, our national debt stood at $20 trillion. Fast forward to today, and it has ballooned to an eye-watering $34 trillion. That's a staggering increase, and it's growing much faster than the economy. This debt explosion is like a ticking time bomb. We don't know exactly when it will go off, but it's almost certain to cause problems when we least expect it. The consequences? They could be massive, disrupting not just the financial markets, but the economy as a whole. Now, the second concern is the bond market. Right now, the 10-year bond yield is sitting at around 3.76%. That may not sound like much on its own, but when you compare it to the overinflated stock market valuations, it's clear something's off. Historically, bond yields have been a strong signal of economic health. With yields this low, the market could be pricing in a future recession. And if that's the case, many of the assets in today's market are dangerously overvalued. If you've been following the stock market for a while, this might start to feel eerily familiar. Think back to 1972, when the so-called Nifty 50 stocks were all the rage, trading at extremely high multiples. Investors believed these companies were unstoppable, but within a few years, the bubble burst. Could we be heading for a similar scenario today? It's possible, especially with certain stocks trading at sky-high valuations that seem detached from reality. Let's take Nvidia as an example. This tech giant is trading at over 380 times earnings. That's right, 380 times. To put that into perspective, it's one of the most inflated valuations we've seen in a long time. Sure, Nvidia is a leader in AI and graphics technology, but such a lofty valuation is a red flag. And it's not just Nvidia. Across the tech sector, we're seeing inflated prices that remind some investors of previous market bubbles, like the dot-com crash in 2000. But don't think this means you should just sit on the sidelines. While the risks are real, so are the opportunities. Legendary investor Leon Cooperman, known for his sharp insights into the markets, isn't just cashing out and running for cover. In fact, he's maintaining a balanced portfolio, 20% in bonds and 15% in energy stocks. Why? Because he knows that in turbulent times, energy and bonds can provide a buffer against volatility. Bonds offer some security, while energy stocks have the potential to thrive, especially with ongoing geopolitical tensions. Let's break it down. Energy is a sector that can weather a lot of storms. With everything happening in the Middle East and global energy markets, having a stake in energy companies might be one of the smartest moves you can make right now. Prices can surge as demand spikes, and well-positioned energy companies can reap significant profits. That's why Cooperman is betting big on energy, and it's a strategy worth paying attention to. He's also diversified into what he calls special situations. These are unique investment opportunities that don't necessarily follow market trends, but have strong growth potential. This mix of investments allows him to stay in the market while hedging against the possibility of a downturn. And that's a strategy that can work for anyone who's looking to protect their portfolio while still seeking out profits. Before we continue, if you're finding this video helpful, take a moment to like the video. Here on Economic Hero, we're dedicated to bringing you the best financial insights and strategies to navigate the markets. Don't miss out and hit that subscribe button to stay ahead of the game. Now let's talk about the Federal Reserve. The Fed's recent moves to cut short-term interest rates have been making headlines, but what does it really mean for the market? While cutting rates might provide a short-term boost, Cooperman believes that the long-term rates, like the 10-year bond yield, are going to rise. As the Fed cuts the short end of the yield curve, long-term rates will likely increase, making bonds a more attractive investment as yields rise. It's a tricky balancing act, but one that investors need to pay attention to. At this point, you're probably wondering what specific stocks Cooperman is bullish on. Let's dive into that. First up is Alphabet Inc., better known as Google. Alphabet is Cooperman's sixth largest holding, and with good reason. Google dominates the search engine market with an 80% market share, and despite the rise of AI-driven competition like Microsoft's Bing, Alphabet is staying ahead of the game. Its stronghold on the search market makes it a key player in digital advertising, which continues to grow. Google also benefits from YouTube, which is seeing massive growth in ad revenue. YouTube Shorts, in particular, are gaining popularity, making the platform more competitive with TikTok. Beyond search and YouTube, Google's cloud services are another growth area. Google Cloud is becoming profitable, with margins expected to expand as the company invests heavily in AI and infrastructure. These investments are capital-intensive, but Alphabet's strong balance sheet gives it plenty of room to grow. Cooperman's bet on Alphabet isn't just about today's performance. It's about the future of AI, cloud computing, and digital advertising. Next on Cooperman's list is Devon Energy. This company is a powerhouse in the oil and gas industry. Devon recently made a major acquisition, buying Grayson Mill Energy for $5 billion, significantly expanding its footprint in the Williston Basin. This move is expected to increase Devon's production by 100,000 barrels of oil per day by 2025. That's huge. Devon is also known for its shareholder-friendly policies, including a stock buyback program and a generous dividend. Even with oil prices fluctuating, Devon continues to deliver solid returns. Its disciplined financial management and consistent cash flow make it a standout in the energy sector. Finally, we have Microsoft. Cooperman has trimmed his stake in the tech giant, but he still holds over 105,000 shares. Why? Because Microsoft is positioning itself as a leader in the AI space. With its AI-powered products like Copilot integrated into Office 365 and Windows, Microsoft is ahead of the curve in the race for AI dominance. Azure, Microsoft's cloud platform, is growing at a rapid pace, thanks in part to its AI capabilities. This is a long-term play for Cooperman, who sees AI as a key driver of future growth for Microsoft. To wrap things up, the market is facing some serious challenges, from rising debt to inflated stock valuations. But as Cooperman's strategy shows, there are still opportunities if you know where to look. Whether it's bonds, energy stocks, or tech giants like Alphabet and Microsoft, staying informed and adapting to market conditions is key. Thanks for watching. If you enjoyed this video and want to learn more about smart investing strategies, be sure to like the video and subscribe to Economic Hero for more content. We'll keep you updated on the latest market trends and investment tips to help you stay ahead. See you in the next video.